Very pleased to welcome to Monetary Matters Jeff Snider of Eurodollar University. Jeff, great to see you. How you doing?
Great. Thanks for having me, Jack. It's good to see you too.
Great to see you, and it's my pleasure that you're here. Jeff, I want to start by asking you about the yield curve and the inversion of the yield curve that occurred in March of 2022 or the spring of 2022. We are about 2.5 years after then, and the economy, it's not going gangbusters, but we're not in a recession. So has this idea that a yield curve predicts or causes a recession, can we throw that idea out the window or no? What do you think?
Well, there's a couple things there, Jack. First of all, are we sure we're not in a recession? Because usually you don't find out until long after it's begun. And by the time they actually make a determination, it's already well over, maybe it's almost a year into it. It took the NBER until December of 2008 to finally declare a Great Recession, which by then everybody knew that was happening. And that's not an unusual occurrence. It happens in every cycle. So to say that we're not in a recession when all the economic data we continue to get, yeah, like you said, it doesn't look great, but it does look like it's slowly moving in that direction. So I don't think we can conclusively say, nor should we be reasonably assured that the soft landing is happening. I mean, we went through this just 2 months ago. We got a couple of bad payroll reports, and everybody, oh my God, here it is. Here's the recession, and then it goes quiet. Because that's how these things work. Nothing ever goes in a straight line. I keep saying that all the time. It's true about the marketplace. It's true about the economy. We go in one direction and everybody's happy, soft landing, no landing. Then all of a sudden it's like, oh my God, it's really weak. And then you go back to the other way and it's soft landing, no landing. Then it's really weak. And what you do is you step back and look at it over time, a wider perspective, and you see that every back and forth you go, where's the trend? And the trend is this way. It's lower and lower and lower and lower. So I don't think we can say that we've avoided recession at all, especially when you look around the rest of the world and they're experiencing recessions and they're not getting out of recessions. We're moving more toward everyone else than they are moving toward us. So as far as the yield curve goes and the recession, I mean, this story has not been written yet. And it's not just the yield curve either. There's other markets that are pointing to the same things, or at least the same general idea. And they have not only continued to point to those things, they continue to point to those things even more strongly as we go through time. So as far I understand where people are coming from, because they think, well, the yield curve, that was, like you said, Jack, that's 2.5 years ago. What does that have to do with today? And that's not unusual either. 2.5 years is a little bit longer. It's much longer than normal, but you go through these processes where the yield curve inverts, and you're talking about a multi-year process. The yield curve first inverted in December of 2005. December of 2005. The NBR didn't declare a recession until December of 2008, 3 years later. So these are very long, prolonged processes. And so the challenge here is to look past all of these variations, these back and forth, and say, what is the actual underlying trend? What is the market saying? Are there various markers and signposts and mileposts that we can look at and say, are we still on that same trend? Has anything materially changed since then? And so that's really what the challenge is here, not to just, to get caught up in the back and forth that we always go through.
So Jeff, you say, am I sure that we are not in a recession already? I would say no. I grant it is possible we are already in a recession. I don't think that we are, but I really don't I don't value my own opinions too highly. I would ask you, are you confident that we are in a recession?
I'm pretty confident that if we aren't in a recession, that we're heading toward one. And there's a lot of different reasons for it. And I think we've been heading in that direction more. There's a couple different inflection points. There was one last fall in October where you see a whole bunch of stuff that changed. That's really when unemployment started to rise. Hiring actually fell off, which, by the way, recessions are all about hiring and lack of hiring than they are firing. And I think most people, the impression that they get is that a recession is where you have mass layoffs. And that's usually what comes in at the end. But the trigger for a recession is companies just stop hiring. And we've seen that since last fall. And there was another inflection earlier this year around March and April. We saw consumer confidence fall off sharply. A lot of economic data around the world. I mean, it was very globally synchronized, where March and April, May, that part of the calendar keeps coming up all the time. So there's a couple different inflections that suggest that the downward trend that the economy in the United States has been on accelerated somewhat to the downside. Now, it did fall off a cliff, but that's not how recessions work either. It's not just like flipping a switch where you go from one day it's fine and everything's growing to the next day it's all just crashing and falling apart. It's a very prolonged process, and the initial stages of recession are just a very shallow contraction. And so I think that's where we are in this process. And we've been in that shallow contraction part for quite some time, which is why people are understandably saying, okay, if it was going to happen, it would have already. People have lost patience with the thing. You've been talking about recession all this time. Where is it? If it isn't here, it's not coming. And I think that's an important mistake that people make.
So I grant your point. Yeah, the hiring rate has gone down a lot, and it is roughly where it was in 2012. And however, the unemployment rate, it has gone up, but we're still adding jobs because the layoff rate is still very low as well. So,
But are we having jobs? I mean, that's what the establishment survey says,
mhm.
but even the Fed said, yeah, the establishment survey is way overstated. I mean, we've got the QCEW, which was really heading into a decelerating trend. That was last year before we even get to this year. We don't even know what the QCW looks like this year. It could be even worse. So if you're looking at the establishment survey, yeah, the employment looks like it's softened a little bit in the summer, and that was no big deal, but we know that's overstated. You look at the household survey, which is, yes, it's less reliable. It doesn't sample nearly enough households as it should, but the household survey actually matches a lot more data than the establishment survey does. And the household survey is actually low. And when I mean low, it's actually negative. So going back to last year when we had that inflection, the household survey is negative since last year. So that is not only do we have a lack of hiring, we have a little bit of layoffs going on there here and there, which we know. I mean, auto industry starting to lay off people. It isn't a massive wave of layoffs like you imagine with a recession, but there are enough labor indications. We have a lack of hiring that started unemployment to rising. And then there have been some job cuts along the way. We know hours are being cut, which is a huge one too. Even the establishment survey data on hours, that one has fallen. The average work week is 34.2 hours, which is solidly in recession territory. The hours index has been flat to slightly lower for the last six months or so. So we have a lot of labor market data that looks like the beginning stage of recession, even if the payroll report, which is wildly overstated, doesn't. So you hear companies talking about how they're struggling. You hear companies in these earnings reports saying we might need to do something about our costs. And you see it in a lot of labor market data that's very much consistent with the way the markets are behaving, the way recession processes develop. So I keep coming back to the same question. Okay, it's been a long period of time, but are there consistent, concrete signposts that we can line up and look at and say, are we still on the same trend? Or have we hit the soft landing? Or even better, have we avoided the recession entirely and just continued on as if it wasn't even a question? And we keep coming back to, even if it's taking a lot of time, this slow deterioration and degradation that's also consistent with what we see around the rest of the world.
The hiring rate has gone down a lot, but the layoff rate, which I believe is from the same report, is still low as well, despite the 3,000 people got laid off from some high-end tech company. That's not where a lot of the jobs are. Jeff, one thing I'll just ask you about is, you say consumer sentiment has been very bad, but hasn't consumer sentiment been quite bad for over 2 years now? And people are spending. People are spending a lot of money. Personal consumption expenditures are up 5.3%, 5.2% year over year. And so the rate of growth is going down. They used to be spending 10% year over year growth. Now they're only growing 5% year over year. But you're looking at the surveys, but I'm looking at what they're doing. So which should we pay attention to?
Well, consumer confidence isn't really about spending. And I know that's the natural link. You think if consumers aren't confident, they're not going to spend. That's not what consumer confidence really tells us. Consumer confidence is consumers' perceptions of the labor market. That's why there's a very strong correlation between the unemployment rate and, say, like the University of Michigan's consumer confidence number. And the one exception is what you're really pointing out, Jack, is a couple of years ago. Consumer confidence absolutely crashed in the middle of 2022, which had nothing to do with the labor market. It was all about consumer prices. Mm-hmm. So consumer confidence crashed in 2022. Again, that has nothing to do with consumer spendings. That was just consumers saying, we don't like the fact that we're losing a ton of purchasing power. We're going to continue to spend. We really don't have much choice. Prices are going up. We have to continue to spend. So what the consumer confidence told us in 2022 was that consumers were upset about consumer price changes. And then consumer price change rates kept going down and down and down, which led to consumer confidence rising. So 2023, you had the rebound in consumer confidence that stopped around early part of this year. So what you saw is a bunch of consumer confidence surveys transition from consumers focused on consumer prices being their main concern, their main complaint, really, to all of a sudden in March and April, they were no longer talking about consumer prices because those were starting the disinflation, deceleration, and everything else. They started to transition toward a more normal business cycle dynamic where consumers became more and more pessimistic, not because prices were accelerating, but because they could perceive changes in the labor market, which is why historically you have, as I said, consumer confidence really corresponds strongly with something like the unemployment rate. So when consumer confidence is going down, it's not about spending. It's consumers saying, I don't like the fact that there aren't any jobs out there. My hours might be cut. Even if my hours aren't cut, my neighbor, he's talking to me all the time about how his hours got cut, or, the person we both know, their boss is talking about laying people off. So consumer confidence really corresponds strongly with the unemployment rate at a lag, because people start to perceive these changes in the labor market, and it reflects in how they, what they tell surveyors about how confident they are. So it's not really about spending. It's another angle looking into the labor market.
So what do you think is going to be a catalyst to put this economy into a recession, or put it into the phase of the recession where the MBER declares it? Because you do grant, the economy is still growing, or appears to grow. What's going to be the catalyst?
The catalyst is usually where hiring falls off enough that it triggers a backlash in spending, that and not just consumer spending, but business spending as well. And so you see that's happening too. You look at some of the construction spending data, or non-residential constructions, fixed asset investment. The GDP version's a little bit different. That one looks a little bit better. But the Census Bureau construction, non-residential construction, that's a highly cyclical indicator. That one's starting to roll over and become negative too. So you put these two things together, consumers start to slow down spending, which they have slowed down in nominal terms. But like you said, Jack, it's not falling off a cliff. We're not in a period where we can say, okay, this thing is becoming really terrible and it looks like a recession. We're in that phase where the slowdown still looks like a slowdown, and everybody just assumes that the slowdown will itself slow down into some kind of gentle soft landing. So you have this combination. Really, what recessions are is not just one thing or another. Towards combination of things start to happen simultaneously. Some people have called this a rolling recession, which is maybe a fairly good description, where you have contraction over here, but really strength over here. And then there's a contraction over here. And this one part that was contracting that's now doing really well. And you don't have the synchronization of all these weak parts. And one of those, for example, construction jobs continue to be, or at least according to the establishment survey, continue to grow at a pretty substantial rate. And construction jobs, highly cyclical too. And that's one that's continued on in the face of what should be pretty substantial weakness, given some of the other statistics on construction itself, not just non-residential construction, but apartment construction, multifamilies. That has fallen off too. So when all of these negative signals start to combine and synchronize together, that's when you get the sort of backlash that we all associate with recession. Consumers really start to pull back, not just a little bit here and there, but really start to, I'm not going to buy any appliances, I'm not going to buy a car, that kind of thing. Businesses really start to pull back on investment. We already know they've pulled back on hiring. They've cut their hours for a lot of workers in a lot of different industries. They start to do even more of that. And then eventually, if they're pushed far enough, that's where you get to the layoffs. And a lot of it has to do in this cycle with the nominal slowdown, because that's what's been the most abnormal part of this over the couple of years leading up to now, has been the fact that nominally everything looks even better. Because you have the price changes from the 2021 and 2022. So in nominal terms, you still have a lot of, especially in 2023, you still have a lot of nominal growth that continues to slow down. And there's a huge mismatch between what the nominal economy looks like and what the real economy looks like. And as the nominal economy slows down, everybody has to normalize to the real economy. So you might have, the auto industry is a perfect example of this, because for a couple of years there, it looked like the car business was the place to be. Prices soared ahead. Revenues at all of these automakers was just absolutely fantastic. But they weren't selling that many cars. It was simply price changes. Now that the price changes have stopped changing, now we have prices actually starting to level off and fall. All the automakers are like, We don't make that many cars. What do we need all of these factories for? What do we need all of these workers for? But over the last several years, where they should have been laying off workers and cutting back on production, they haven't been, because the nominal change was still robust, and they could hang on and think, well, we're going to go into a soft landing anyway, so let's just hold on to our workers and facilities, because when the economy goes roaring ahead in 2024 or 2025, we're going to need all of those workers. So as the nominal economy slows down, the outlook for 2024 and 2025 shifts, and all these businesses start looking at what they actually produce and what they actually need to produce. Now they're starting to make those decisions, like, okay, do we really need all of these workers? We don't want to get rid of them, and we've been holding on to them far longer than we would have in any other cycle. So maybe we do need to start thinking about laying people off or doing some other things. And I think that's where we're going with the nominal slowdown, is forcing a lot of uncomfortable discussions about what do we actually produce in terms of volume, because the volume economy looks so much different than the nominal one. And the volume economy is really kind of frightening, especially when you look at it around the rest of the world. There was never a recovery in the volume economy. The prices there was a huge price illusion that made it look like it was red hot and everything was booming. But in terms of actual volume growth, it was never there.
So nominal is what it is nominal. Real is inflation adjusted. So over the inflationary period of the past 3 years, everything has appeared high because inflation itself is high, but the real numbers weren't that good. But as inflation has fallen, Jeff, if you look at the second derivative, nominal has been falling a lot, but real has actually, the rate of growth of real has been going up because inflation has fallen. So, real spending is way up. Real construction, real earnings are up. Real wages are up a lot because inflation is no longer at 9%. It's now somewhere between 2 to 3%. And therefore, after you adjust for inflation, you have to adjust way less. So adjusting for inflation, this economy in real terms looks pretty good. Do you agree?
No, I don't. Sorry, Jack. Because you look at some of the real statistics and they don't look like they're accelerating. For example, real income. Since a lot of what we really want to focus on is income. Income is a big part of everything. I mean, it's basically the centerpiece of any economy. So as a nominal incomes, like for example, disposable personal income. Disposable personal income nominally has fallen off. So the 3-month rate is the lowest it's been since we started the cycle. And you would think, as you're saying, with consumer prices falling, therefore that change, the nominal change should be, or the real change should be much better, because if you have less inflation, then the real terms incomes go up. But that hasn't been the case. Real DPI has been essentially flat to slightly lower over the same period too, because nominal incomes have slowed down so much. They're slowing down as fast as consumer prices, or in some industries, they're slowing down faster than consumer price changes. So in certain places, what you're seeing is that even as consumer price rates go down, nominal incomes are slowing down faster, which leaves us even further behind. But this is one of the reasons why consumer sentiment is down as much as it is because most people are saying we can see this nominal change in incomes. So even as consumer prices have no longer the most important variable that is really impacting consumers, they can tell that there's this shift to income. They were expecting exactly what you were saying. People were expecting as consumer price rates go down, they would begin to start to claw back some of that lost purchasing power, because nominal growth, nominal wages, nominal pay would stay relatively constant. That's what everybody said. That's what a soft landing means, right? That we don't have a big change in the nominal income. So nominal anything. So as nominal incomes have slowed way down, it caught a lot of consumers off guard because they were expecting to be made, at least to start being made whole. And one of the reasons why consumer confidence fell off a cliff was because they realized nominal incomes are slowing faster than price changes. So we keep falling further and further behind. And you can see that in a whole lot of statistics, whether it be income, like I said, disposable personal income, real personal income, excluding transfer receipts. That one is just like this too. Price adjusted, there's no growth there. And no growth is a contraction because we need solid growth in a nonlinear world. So there's a contraction in real income there. Look at on the other side in terms of retail sales. Mm-hmm. You look at nominal retail sales. Those have flattened out quite a bit. Retail sales are under 3% nominal growth, which is recession. Anything less than 3% nominal is solidly in the danger zone recession territory. But look at real retail sales. Real retail sales, I could say it. Real retail sales have been flat for a couple of years, and they've fallen off to the point where if you actually plot the trend from the 2010s, the real retail sales is behind the 2010s trend over the last several months. So while we're still paying a little bit more to buy goods, we're actually getting less goods. And we're getting less goods than we would have had there not been a pandemic, supply shock, and everything else. So again, the nominal economy is slowing down. The real economy is not picking up to make up for the difference. And yes, there are some places like GDP where the real economy looks much better for some other reasons that have less to do with the private economy. But I think when you actually look at some of the income is a big one, spending in terms of retail sales, it lines up much better with the slow change in the economy heading toward a recession.
So yeah, I have real disposable personal income growing at 3.1%, which appears to me to be the average of the post GFC world. And then nominal is growing at 5.3%. But again, inflation's at 2%. So that's why you get 3.1%. Advanced retail sales does look bad. Definitely. I'm looking at the nominal one. It's growing 1.4%. So adjusted by inflation, that's a negative real growth rate, which is bad. But Jeff, the personal consumption expenditures, not the price index that the Federal Reserve pays attention to, but actually just how much people are spending, is growing at 5.2%. So adjusted for inflation, that's about 3%. So 3% real sounds pretty good.
Except most of that is backloaded. That's last year. You look at just the last 6 months or even the last 3 months, and it looks a lot different. That's where you see the slowdown. The slowdown really happened, as I said, the inflection point earlier this year. So if you look at the year-over-year change, you've got, first of all, you got the January boost in income, which that's now a big part. Cost of living increases, wage increases that happen every January. Big one in 2023, somewhat less of one in January 2024, though the Census Bureau really underestimated that this year too. But you look at just the last 6 months, and you see the slowdown. So it was the year-over-year change is 3%. What is the last 6 months? It's actually down under 1%. And real DPI, I believe, is basically zero. I'm going off the top of my head, but I think it's pretty close to zero over the last 6 months. So you got nominal slowing down over the last 6 months. You got the real spending not making up the difference. And the reason is because the labor market has become increasingly soft. It's a factor of, first of all, lack of hiring. So if you don't like the job that you're at, you're kind of stuck there. You don't like what you're getting paid. You can't really move anyplace else. You've got a lot of hours being cut. We see that everywhere across all of the labor market data. That does show up in certain accounts, such as average weekly earnings. And so it's, like I said, there's an inflection point that happened earlier this year, which is the entire reason why we had this summertime freak out in basically everywhere, because all of those changes started to synchronize in the way that was familiar with a recession. So by the time we got to July, the Fed was actually thinking about cutting rates in July because they could see the weakness coming in. And then August and September, they're like, okay, crap is really happening. And ever since then, it's been, okay, the September payroll report was really good. Well, the headline was good. The rest of it was not. And so the idea is that suddenly the economy healed itself just over a period of a couple of weeks. And so we avoided the hard landing recession because of one payroll report, when all of the evidence continues to show that there's a big time change over the last 6 months, and nothing ever really goes in a straight line. So again, I keep going back to, what is the trend here? Is the trend really the economy growing at a solid 3% rate in real terms? Or is that 3% rate backloaded to last year? And the real change, the real rate of change, and really the delta here over the last 6 months is much, much different. And I think that's where we got this recession freak out over the last couple of months, is people realized that the economy they thought was solid and everything looked sort of okay. We could feel that there was a big change, and it wasn't just one thing or another. It was a widespread phenomena that hit a whole bunch of different things at the same time.
So I think that's a fair criticism from you, that looking at the year over year, it doesn't take into account the more recent changes. So let's look at something, the Atlanta Fed GDP now, which tries and prices what the next quarter real GDP quarter over quarter will be, adjusted for inflation and annualized. So we have that at 3.3%. So what do you think about that? Is that wrong?
I have no idea. The GDP now does not have a great track record, but even if it does, GDP doesn't have a great track record at inflections either. Again, you can look at any number of cyclical changes. 2007, it had a big GDP number in the third quarter of 2007, just before the bottom fell out. It had a big GDP quarter, not necessarily big, but it was relatively, it was reassuring in the fourth quarter of 2000, just before actually first quarter of 2001, just before the dot-com recession started. GDP is a lagging indicator. It's not a forward-looking indicator. So if GDP now is correct, and let's assume that it is, and GDP accelerated from the first quarter, which was kind of weak, second quarter better, third quarter gets to 3.3%, everything looks great. That just tells you where we were. And why was GDP up at 3.3%? It's not because of consumer spending. It's not because of business investment. So where is that actually coming from? I mean, that's why it's not a forward-looking indicator.
Right. So I'm looking real GDP in Q4 2007, which is when the recession began, was 2.1%, and now we're at 3%.
It was better than that in the original estimate. We got to remember, you're looking at the revised figures. When they initially come out, they come out way better than that. I think it was almost 3% in the fourth quarter. If you actually look at the initial press release that came out in October of 2007. In fact, that was one of the reasons why the Fed thought that was their last rate cut. The Fed cut by 50 basis points in September 2007. Then they cut by 25 in October, the end of October. And they discussed that GDP report. They also discussed an acceleration in the payrolls, because the payroll had been slightly negative in August of 2007, then picked up in September and picked up again in October. And so they looked at GDP, looked at payrolls, and they thought, we don't need to cut rates anymore. We did 15 to 25. We're done. They thought that was it, because these statistics look good and they go back and forth even while recession is actually taking place. You can get a really good GDP number. You get two really good GDP numbers in a row. The dot-com recession, for example, there was no really bad quarter in the dot-coms, nor were there two quarters in a row where it was negative. You had one negative in the second quarter of 2001, then you had a positive in the third, and then you had a negative in the fourth. And GDP basically just went sideways. It didn't really contract all that much. So again, GDP is not really the best statistic to really try to gauge where we are in the cyclical process.
What about the unemployment rate?
The unemployment rate is better, but it still has its own problems. The unemployment rate since 2008 is all about the participation problem, which has only gotten worse. What is the actual unemployment rate? We have no really idea, because the official tally of unemployment doesn't consider those who aren't seeking jobs, and why it doesn't really ask people why they're not seeking jobs. So the unemployment rate is better whenever you see a large move in the unemployment rate higher, which we have over the last year plus. That is a solid, consistent recession signal.
Okay. So for the audience at home, the unemployment rate, the numerator is the amount of people who are unemployed. The denominator is the amount of people who are looking for work. It's not everyone. So to be in the labor force, you have to be an adult age and actively looking for work. So Jeff, I think it's fair to say that most of your life, from the 1960s to the 2000s, the labor force participation rate has been going up, and now it's been going down. But when the labor force participation rate in the 1960s was at 60%, it's not like the economy was in a recession then, right?
Yeah, but it does apples to oranges. You can't compare the economy, the labor force in the 1960s today. And the labor force participation, which was changing as we entered the 21st century, some of that was demographics, as many people point out, because we have an aging population, but not all of it was. And there's a reason why we have a major shift in the participation rate in 2008 and afterward. Because as you mentioned before, we have a hiring rate that's equal to 2012. When you go back to 2012 and before, the hiring rate was so bad that we had people falling out of the labor force and therefore falling out of the unemployment rate. And they never actually came back. Now, the unemployment participation among prime working age people did eventually rise in the second half of the 2010s, but by then the damage was already done. So yes, the participation rate has been falling the entire 21st century, but not all of that is because of demographics. And you have to look at some of the other possible reasons why that is, and why that would be the case when you see these major changes. Why would the participation rate fall so much after 2008? It wasn't as if that a lot of baby boomers decided to retire in October 2008 as the stock market was crashing. It was because the level of jobs and employment fell off to such an extent and never came back that people just stopped looking for work. And I think some of that happened to an extent in 2021 and 2022 as well. I think there's this misconception that everybody was, government stimulus, government paychecks, labor hoarding, labor shortage, all of that stuff, that the labor market was so exceptionally robust. How could you possibly have a participation problem during that period? But you look at the participation rates and they fell off, especially among young people, which is another classic sign of an economy that's not performing well. You see it in Japan all the time. China is another one. Wherever you see youth unemployment rising and youth lack of participation in the labor force among younger people, that's a clear sign of an economy that's struggling. And that's what we've seen there as well. So the participation problem means that the unemployment rate is understated. But even if it is, setting that aside, the unemployment rate has risen from, where was it, 3.4% at a low last year, up to around 4.4% as the recent high. It's backed off to like 4.1 again. But even that much is enough. You only see that type of rise as during a recessionary period. So even though it was low, a low unemployment rate is, again, it's not a protection against recession. In fact, the record low unemployment rate was hit in the 1950s, the month before a recession began. So that's a consistent part of what we see in the recessionary process. And it's in the initial stage is not layoffs, as we keep coming back to. It's really the initial stage of unemployment is that companies stop hiring, because there's always a fair amount of churn in the labor market to begin with. And if companies just stop hiring, you have that the number of officially and unofficially unemployed that just starts to pile up, that it leads to the second and third order effects.
All good points, Jeff. And yes, I believe that the average unemployment rate in the first month of a recession is in the 4%. So or maybe even 3%. And in the 1950s, yeah, the unemployment rate was like 2.6%, and then there was a recession. So recessions actually are much more likely to start when the unemployment rate is low than when it's high, because when it's high, it's during or after a recession. Jeff, just to go back to my first question about, is the inverted yield curve wrong, which I like posting these fun questions because I know, of course, you're going to push back, is that, so just to do the timing, the yield curve, 2-year treasury yield, 10-year treasury yield, that spread inverted in February 2006. The NBER declared recession started in December 2007. As you pointed out, and as David Rosenberg pointed out, the NBER didn't declare that until December 2008. Okay, so now I'm looking at the 210 inversion, which occurred in March 2022. Just putting the same number of months, that would have meant that the recession started in January 2024, and that the NBER will declare it in January 2025. If it's February 2025 or March 2025, and the NBER hasn't declared a recession, do you think there's going to be a little bit of pressure to re-examine the yield curve and see if this time it was wrong?
No, because I don't care about the NBER. I could care less about the NBER. And you can't apply, none of these cycles are uniform. You can't apply a template. You can't say if it's a year later than they haven't. I'll give you a perfect example. The Japanese, there was a recession in Japan that began in late 2018. The reason why the Fed cut rates in 2019 is because the global economy really fell off sharply. You had probably a recession in Europe. This is all pre-pandemic. We don't know how it would have turned out in the United States because the pandemic kind of changed everything. But we had a recession, an unofficial recession in Europe, and you had one in Japan that started in October of 2018. The Japanese government declared that recession, was it last year or the year before? 2022, I believe it was. So in July of 2022, they said, oh, by the way, we had a recession that began in 2018. So it took them 3.5 years to figure out that, yeah, we did have a recession. So I don't care what the NBER says or what the Japanese ESRI says. It's not about economists deciding what a recession is. It's about looking at the actual weight of evidence and seeing, are we still on the same trend? Understanding that all of these cycles, they're unique. They all have their different tempo, their different paces, the different reasons for them. It's never the same every single time. So if you can't apply a single quantitative measure to any type of recession, and really all a yield curve is telling us, and yield curve inversion, because that's really what you want to talk about, right, Jack? Let's talk about the yield curve. What is the yield curve actually telling us? The yield curve is not saying recession. That's not what it says at all. The yield curve is completely agnostic on the issue of the economy. That's us interpreting what must be happening, what the yield curve signal is. All the yield curve inversion is saying is that we're looking at where interest rates are now, where they're likely to go in the short run, and then where they're likely to be in the long run. And an inversion says that wherever interest rates are in the short run, they're going to end up going lower in the long run. Now, normally that's associated with recession, which is why it's a recession signal, because interest rates tend to go up heading into a recession, not because of central banks, because during a growth period, you have growth, higher growth and inflation expectations, which mean rising rates. Rising rates are actually a good thing, not a bad thing. So as rates go up, you think, okay, everything's really good, but the yield curve starts to invert, which is the marketplace starting to pick up on signals that suggest that something's going to take place, and we don't know what that something is, which will end up with interest rates going lower over time. That's really all an inversion says. And so it's incumbent upon us to interpret that signal, given a whole bunch of other parameters and factors that we're starting with, and think, okay, how do we get from where we are, where interest rates are today, and where lower interest rates are tomorrow, and what would that actually mean? And most of the times I said it's about recession, but that's really all the yield curve is saying, is that it's about rates going down over time. And really, you never want to look at one signal or another. So you look at other market signals, say interest rate swap spreads. Interest rate swap spread, especially the longer dated ones, tend to relate to not just where interest rates are going to go in the short run or the intermediate term, but also the longer run. And so swap spreads have been saying, we agree with the yield curve that rates are going to go down, but we're going to add another parameter to that, because especially the longer dated swap spreads are going to say, not only are interest rates going to go down, they're going to go down quite a bit. And then worst of all, they're likely to stay there, which, I mean, what does that actually mean? Does that mean a recession? Well, I mean, it doesn't necessarily have to mean a recession, but it's likely that that's part of the process that gets us from where we are today to where interest rates are going down and staying down. But it doesn't have to be. We could go into a period, for example, like the dot-com recession, where you don't actually have a recession, where just GDP levels off and goes sideways for a long period of time. You don't have a massive number of layoffs, but you do have a lack of hiring. So unemployment starts to build up and build up and build up. And it feels like a really bad recession. And growth potential goes off and falls down and continues to go lower. And so interest rates would reflect that longer run trajectory. We don't have a whole lot of growth potential without having a recession in between. I mean, that's certainly a possibility. It's certainly something you always want to examine, but that's really all the inversions are telling us. And that's all really the markets are telling us is, look, interest rates are likely to go down, and they're likely to stay there once they get wherever they're going. And it's up to us to figure out, well, how does that actually work? How do we get from here to there? And that's where, you look at the trend in the macroeconomic data that continues to move in that direction. And it seems like that's what it all adds up to be. It adds up to where we are today is in the aftermath of a period of artificial and unusual conditions that have more completely worn off more lately. And we're transitioning to a longer run future that sadly looks more like the 2010s than not. And so how do we get from there to there? It seems like, as Europe has shown, as Japan has shown, as a lot of places around the world have shown, there's likely to be some degree of contraction in the general economy along the way. Employment is too high. Companies hired way too many workers thinking that 2021 was a real legitimate recovery. Now they're looking at how many goods do I actually produce? How many factories do I actually use? And now they're looking, okay, we hired too many workers. We've got way too much production. The volume of the economy is well below where we thought it was. We have to make adjustments. We have to realign our business to where that long run trend is. And it's not the trend that we thought it was in 21. So you keep coming back to that. What does the actual process look like to get there? I mean, who knows, but it looks more and more like that. It has to be some type of realignment that involves fewer people working, less income, less spending, less investment. Maybe that's not a recession, but it kind of sounds like one.
Right. And the yield curve is just the price of money from one day overnight to 30 years. And over the past 40 years, we've had declining interest rates. So anytime there's an inverted yield curve, I think all of the time over the past 40 years, it's been because the Federal Reserve raises rates. They control the overnight rate, they raise that rate, and then the 2-year prices in that, and that the 2-year is way higher than the rest of the curve. So is the reason for the slowdown over the past 2 to 3 years, slowdown in nominal terms, leaving aside whether it's actually recession or just a soft landing, that is inflation going down, but real growth actually going up or staying stagnant, was it the Federal Reserve that has caused things to soften?
God, no. If the Federal Reserve did what it said it would do, then everything would have slowed down and crashed right away, right? I mean, they had the most aggressive series of rate hikes in forever. And they spent the most part of this year figuring out, well, why aren't consumer prices decelerating as fast as we thought they would? We focus way too much on interest rates as some kind of lever in the real economy, when it's actually interest rates, as Alan Greenspan himself pointed out many times, interest rates are information about the economy, not some means to manipulate economic growth or potential. And no, the Fed does not hike. There's not policy errors. The Fed doesn't hike our way into a recession. The Fed simply responds to conditions and moves the short-term interest rate around based on its perceptions of what it thinks it needs to do. Where I mean, they don't even know where the neutral interest rate is, let alone the natural interest rate. So they're just throwing an interest rate, moving it up and down. And what the market is actually saying at these times is that, okay, Alan Greenspan or Jay Powell or whoever the Fed chairman happens to be, you've raised the short-term interest rate well above where it should be, and the long-term rates are saying it should be much less than where you've got them. So that doesn't necessarily mean that the increase in the long-term rate is what caused the recession that follows. It just means that the Federal Reserve mispriced a short end of the curve. That's all it really means. Again, interest rates are agnostic about the macroeconomic factors. It's just, okay, short rates are way too high and they need to come down because conditions in the real economy don't warrant high short-term interest rates.
But short-term interest rates are high because of the Federal Reserve, yes?
That's the case, sure.
Yes. And so do you think short-term interest rates impact growth?
They can in some sectors, and it depends upon the makeup of the economy. You can make the argument that the interest rate sensitive parts of the economy back in, say, like you were saying before, the 1960s, would have made an interest rate targeting regime far more effective because you had, for example, a housing boom going on. So housing is obviously a very interest rate sensitive sector of the economy, and it was a much bigger part of the economy during the 1960s and 1970s. But the Fed didn't really target interest rates back then. They were market determined. And now we have in a period, especially after the big housing bust in 2008, 2009, 2010, where the interest rate sensitive sectors of the economy are far less important and proportional than they used to be. Mm-hmm. So even though the short-term interest rates do have an impact in certain parts of the economy, they don't have as much of an impact as people make it out to be. They overstate the ability of the Fed to influence economic factors, which, I mean, that was arguable all along to begin with. And it's certainly even more arguable now that interest rate sensitive sectors of the economy are so much less than they used to be.
So, Jeff, when the 2-year surges on one day or it declines on one day, I think you and I have a slight difference of interpretation. I perceive the hedge fund traders who are incredibly levered, trading these 2-year notes and interest rates all over the place, as just in pricing in what the Federal Reserve is going to do and how that impacts them. I think you perceive them as pricing in what should be the true price of money according to growth and inflation and liquidity preference. I think a lot of these traders are paying attention to the Fed, but we disagree.
Yeah, but they're not the only ones in the market, are they? They can't be. If they were, then the 2-year would follow the Fed. They would never invert. The fact that the 2-year inverts at all tells you that you're only looking at a small section of the marketplace. There must be much more of it. And the 2-year is a very interesting spot, and it's one of the important spots for that very reason. It's where you start to get the confluence of longer run interest rates, which are more fundamentally determined, and you still have an eye on the Fed and short-term factors and interest rate policy. So the 2-year is where those two things start to really collide. And so if you get a solid signal in one direction or the other from the 2-year, if it's defying the Fed, then it's not these traders trading on the Fed, it's the fundamentals. They're trading on the fundamentals. There's real financial players who go further out down the curve, and they're taking those signals and saying, okay, I don't care what the Fed's doing. I'm thinking that the longer run potential is different from what the Federal Reserve says or what the Federal Reserve wants to do. So the 2-year is that spot where you really want to pay attention because it has these two things colliding. And if it makes a very solid signal that's different from one or the other, the long run, it's long run's really depressed, but the 2-year starts to really rise. I tell you that the marketplace is shifting. Maybe we don't think the long run has the right idea. Or in the other case, like we've seen over the last really year, going back to last October when the bond rally got going, what did the 2-year do? The 2-year has been one of the best performing spots on the curve, even though initially, what was the Fed saying? Higher for longer, higher for longer, sticky inflation. The 2-year was like, nope, don't see that. So no, there's obviously more going on at the 2-year than just traders saying, what is Jay Powell going to do for 2 years? And this is true of derivatives too. You go to what used to be Eurodollar futures, now term SOFR futures. And I really hate term SOFR futures, but that's what we have. Term SOFR futures, the first 4 contracts are basically all about the Fed. because in the short run, the Federal Reserve is going to do what the Fed does. And it usually takes the Fed a very long time to realize its mistakes and turn around. And so you look at the first 4, maybe 8 contracts, and it's okay, it's heavily influenced by the Federal Reserve. And if you start to see some of those contracts trade contrary to the Fed's policy, then you know, okay, there's the stuff that's going on in the long run is starting to infect the short run too, which means the market is shifting its thinking away from just what Jay Powell thinks into maybe there's more going on than just interest rate policy. So this is true across many of the markets. I think that's a misconception that people have. A lot of people have that the Fed controls interest rates, and it only has a limited ability to affect a small part of the yield curve or derivative curves. And even that it's not mechanical, it's not structural either. And that changes all the time as well based on conditions.
So the 2-year has rallied massively. I think I would say for an unlevered investor, they have made, a single digit return on that. For levered investors, it actually hasn't been as good as it looked like because the curve is still inverted. So it's not you've been paying a negative carry. So that's just a point of how,
Again,
trading.
why would people pay a negative carry?
Because they think interest rates are going down. So if you want to make money, they have to go down by more than it's expected.
Right. So these are rational actors who are making decisions based on their perceptions. And they're saying that we're willing to pay a premium to own this instrument because we think that conditions are going to lead to this. We think that conditions are going to end up very different than what the Federal Reserve says.
Right. But Jeff, the yield curve, the short-term interest rate futures, they have been way too early in pricing in Fed action. I mean, this time they got it right, but in 2022, and then the March bank panic, and then another time as well, December 2023, they priced in rapid Federal Reserve rate cuts that didn't. So I'd say there's been 3 times the bond market was fighting the Fed's no landing verbiage that they got it wrong. This time though, they did get it right. I totally grant you that.
Yeah, that's not unusual either. Look at how Eurodollar futures behaved before 2008. You had the same thing. You had a head fake in 2006 and early 2007. Then you had the Eurodollar futures curve and the yield curve to an extent uninvert in the middle of 2007. It was like, okay, we got this one wrong. Maybe the Fed was right and subprime was contained. And then, oh my God, it happened. So that's not unusual either. These markets are not perfect. Again, nothing goes in a straight line. And so you can get caught up in these trends where things look like they're going in one direction, and then all of a sudden they stop and go around the other direction. For example, the bond rally. The bond rally that began last October, it came out really fast, really hard. Interest rates fell really sharply initially. And then what happened? Rates backed up for several months, and they backed up quite a bit over several months. And I said at the time, I'm like, look, this is what's going to happen. The market is not going to continue to go down. You're going to see rates back up because that's what happens every time. 2008, 2000, 1990, what you see is rates go down, then they go back up, then they go down, then they go back up. It goes back and forth all the time. That is not unusual. And so what we're really looking at is the trend. We're looking at changes in the curve shape to see is this time the rates going back up? Is this materially different? Is the market repricing a different set of risk, or is this just the usual fluctuations as we move in the same trend? So it's not unusual to see these back and forth. No markets are perfect, which is why you never want to fixate on one signal or another. You want to look at a wide variety of signals because you want corroboration across a whole bunch of different elements and dynamics. So you're right, Jack. That's absolutely, the markets do get ahead of themselves, then they pull back, and then they get ahead of themselves and they pull back. But when you step back and look at it, the trend continues to move in that same direction regardless. It's tuning out the variation and focusing on the trend, which is not easy to do. We can disagree about the macroeconomic data, and we perfectly understandable why we would, because if this was easy, if there was just a single set of numbers that we could all look at and say, this is what this says recession, and this is what exactly leads to recession, we wouldn't need to listen to anybody. We just have a web page with all these numbers. And it's the same with the markets. Markets are not perfect. They're not perfect tools. They're imperfect. And they're also, in a dynamic world, you're never really sure exactly what's going on. And so we have this real big challenge to try to decipher these useful signals out of what is a whole bunch of noise. And it is tremendous amount of noise.
There is a lot of noise. Jeff, what have you made of what's been going on in the banking system? I know you like to pay attention to the volume of credit creation as well as the delinquencies on these loans. it's interesting that to me there seems some data that the banking system had a contraction in credit in January 2023 or 2023, and that it's coming out of that, which is interesting. Yeah, how do you read about what's your read on the banking system?
Well, some of the, there's a little bit of growth in credit creation, but it's not economic sectors. It's certainly not cyclical. More of it's financial than not. And a lot of it's tied to perceptions of lower interest rates, which again, interest rate sensitive sector of the economy. But even if you set that stuff aside, the amount of credit growth that's happened over the last 6 months, really this year entirely, still doesn't change the trend at all. You see the same thing in Europe too, where you have credit contraction, a small amount of credit contraction in 2023, and then late 2023 to early 24, credit started to pick up a little bit, but almost all of that was in loans to investment funds. Again, not exactly the most productive sector of the economy. At the same time, the banks are owning more and more government debt in Europe as well as the United States. There's a huge appetite for safe and liquid. So again, talk about our earlier discussion about who's actually buying these government bonds. Banks are buying a ton of government bonds in the U.S. as well as Europe. So there's not a whole lot of risk-taking appetite across the banking system. That really hasn't changed. And even the small contraction in credit in 23 wasn't really all that much. So that was more of a fluctuation to the downside. And in some ways, the credit increase in 2024 is just the opposite side of that, somewhat of like a reversion to the mean, where overall credit contraction or the credit trend has been much, much slower, not necessarily falling off sharply. So that really hasn't changed at all. And the behavior of the banking system in the United States, Europe, Japan's another one. China, the Chinese banking system is just a complete mess. You look at the banking system around the rest of the world, it is still incredibly risk averse, even if it's not, it's not some kind of massive crisis where everything is just falling apart.
Yeah, I'm looking at commercial industrial loans. It's interesting. It's tough because there was a huge surge during the recession of March and April 2020 because of, I think, PPP. And then loans, there was a huge credit contraction during probably the biggest expansion on record from April 2020 to 2021. But then there's also the bond market, investment grade, high yield corporate bond market, the leveraged loan market, private credit market. I feel like there are a lot of things, Jeff, that don't appear on Fred.com, commercial industrial loans, that actually indicate that credit is way easier than this, I agree, somewhat stagnant chart would suggest. So, for example, I think that you make a comparison to how you talk about how the Eurodollar system is what actually matters, and that is separate from what the Federal Reserve is doing with interest rates. I might say, is there an analogy where the bond market and the levered financial system and the new world or the rapidly expanding world of private credit, that is what really matters to the marginal dollar of credit creation, rather than the banking reports that are published by the Federal Reserve from commercial, old school banking. I mean, I'm looking at SIFMA's high yield bond issuance, $38 billion of high yield bond issuance in September 2024, record CLO issuance. Credit spreads are very, very low. Credit's pretty easy, and it seems like there's a lot of capital markets activity and lending in the financial sector. I mean, the big banks just reported, I think, Jefferies investment banking revenues were up like 41% or something. Things are getting a little hot.
Yes, for certain sectors. The reason why we look at the banking sector is because it's a redistribution and it's intermediation. You don't see small and medium-sized businesses issuing bonds. I mean, yeah, there's some of that in high in CLOs and leverage loans and things like that, but that's not where, the importance of the banking sector is, yeah, big companies can borrow all the money they want. That doesn't necessarily tell us much or anything. So if Alphabet is issuing bonds to buy back shares, that doesn't mean the economy is red hot. That just means the financial system is. And in many ways, that's a negative signal. That means that most of the marketplace is focused on safety and liquidity, which is what we're really talking about here. Private credit is all about safety and liquidity, even if it takes really junky corporate loans and packages them together in a CLO. The real point of that is to distill the securitization structure down into a safe investment, which is the super senior and senior pieces of the tranche of the structure. So the fact that you have a ton of private credit and no actual bank credit is basically the same problem that we've had since really 2009.
But Jeff, the companies that need the money, that need to be borrowing, they're getting the money. So, and that's the economically sensitive thing, right?
Who are these companies that need the money that are borrowing? I mean, no, that's the point. that they're the companies that actually need the money, these small and medium-sized businesses that are really the growth engine in the economy, don't get the money. They aren't the ones issuing these loans. The ones who are issuing these loans, there's a shitload of them, pardon my French, the shitload of them are zombie companies that are just trying to stay afloat when they should be taken out back and shot. They should be their business should be ended. So you got zombie companies that can issue bonds or issue debt because the marketplace wants these bonds and they want the leverage loans. What we're really missing is retail banking that goes into individual communities and says to the small and medium-sized businesses, you can't get credit anywhere else. I'm where you really need to come back and look. I have some credit for you because my bank is expanding. We're risk taking. We're adding to our balance sheet. The private credit boom is really nothing more than an extension of government's borrowing, which is safety and liquidity above everything else. And that's why you don't have economic growth in the 2010s. And I think that's why we're going back into the 2020s are starting to resemble the 2010s, because the only sectors of the economy that are able to get credit are certain sectors that are the least productive. So yeah, large companies can borrow all they want and they continue to borrow at huge amounts. But what does that do for the general economy? Great for them, great for Wall Street, but what about everything else? That's where the bank credit really comes into it, is because it's a measure of intermediation, of taking money and resources from parts of the economy that have them and taking a little bit of risk in bank balance sheets and redistributing to parts that actually need them. That's what intermediation is really about. And the private credit boom is not intermediation whatsoever. That's simply just doing deals and putting together packages just so that we can have safe and liquid instruments go out the back door.
So a lot of private credit is increasingly just called middle market CLOs, where they're not large bank deals. So, but there is a lot of private credit where they just own the loan and it can be leveraged, which I don't think is a great thing. And it can be not leveraged, but it's not packaged into CLOs. And I would not say, Jeff, that private credit is a risk-free asset class in any means. And yeah, I mean, these are, like, making a mistake, these companies are some of the riskiest companies to lend to on Wall Street, and the payment in kind numbers are going up. And I think if someone were to say to me that, there's so much risk in the high yield junk bond market, but private credit is safe, I think it's the exact opposite. The riskiest deals have been refinanced, it's my perception, out of the high yield bond market into private credit. So I think the repository of risky credit, and I agree, these are not small firms, or middle market, $50 million in revenue, somewhere around there. But the bid is there. The bid is there, Jeff. That's what I say.
Yeah, and most of it is in packaged CLOs and other structured. So what the point of securitization is, like subprime mortgages, and this is not comparable to subprime mortgages, but the point is exactly the same, is to take risky assets and put them into a legal structure that assigns credit risk and cash flows in such a way that the end result is a marketable security that is AAA rated or AA rated or single A rated, but mostly triple and AA rated, that can be then funded in repo. It's a way to connect repo markets with risky assets so that you can, so at the end of the day, you have essentially a liquid security. I'm not saying it's free of credit risk. The credit risk is borne by the equity owners of the structure. In some cases, as we've seen recently with some of the commercial real estate, the mezzanine tranches too. But the point of securitization is to take risky securities and make a liquid asset out of them. And so the demand in the marketplace is for liquid assets rather than strictly loans. And I know what you're saying, Jack, that there is a lot of middle market activity, but still the vast majority of that activity is not in that. It's about securitization and creating liquid instruments. And the reason we're creating liquid instruments is because the rest of the marketplace wants that and that alone. That's really the primary risk that we keep coming back to, that we have since 2008. The financial system wants liquid securities because they know they don't want to want to be leveraged, because everybody has to be leveraged. The downside of leverage is being forced to sell something, right? So if you're leveraged and your funding provider says, I don't want to fund you today, you now have to fire sale your assets. So the trend has been to create liquid security so that if funding becomes difficult, you have a security that there's already a marketplace for. That's really the primary credit risk or liquidity risk that's been driving driving intermediation in the wrong direction. Nobody wants to own individual loans unless there's a marketplace for them. And that's really one of the biggest problems that we had with Silicon Valley Bank and Signature, is that they had a lot of illiquid loans on their market. Signature in particular, they begged the Federal Reserve Bank of New York to take their I forget what kind of loans they were, but to take their corporate loans and package them in collateral so they could borrow from the discount window. Nobody wants to do that, which means that you have a lack of intermediation in the real lending market. And since the 2023 banking crisis, there's no appetite among regional banks to do that either, which is really the last source of intermediation from the US economy. And it's even worse among Europe, because Europe is very top heavy in its banking structure. So from my position, private credit is still all about making liquid securities and undermining intermediation.
Yeah, I don't think that the majority of private credit is packaged into CLOs. And I think the whole point is that you don't have to trade and people get into it so they don't have to mark. And also, I think that a lot of CLOs are not owned by like repo hedge funds. They're owned by banks, and they are insurance funds, and they're. I just think the banking system is a lot less levered than it is in 2007.
Well, yeah, that's the problem. That's the entire problem, is that you have this engine of intermediation that has taken a step back and it's never come back. And Wall Street has done, non-banks in particular, just talk about the broader non-bank category. Non-banks in particular have tried to fill that void because there's an opportunity there. But non-banks are not really set up to do the same scale of intermediation that the banking system had been. So it's an imperfect substitution. And it's an imperfect substitution for a whole bunch of reasons, because we've privileged the banking system to do things that nobody else can. I mean, that's a whole separate discussion. But that is absolutely the problem. The problem is that we have a banking and intermediation that has taken a step back and has never recovered. And then the growth of non-banks is simply a response to that. And it is an imperfect and less efficient way of doing what used to be done more efficiently, and never perfect, but essentially it was much more effective in a widespread real economy fashion. And again, we'll disagree about what's happening in the in the private credit space. It's not a perfect substitution. It's not intermediation in the same degree that you get from a banking system.
So I think we agree that a lot of the credit risks that in 2006 and 2007, and frankly pre-GFC, were borne by the banking system are now borne by the non-banking system, shadow banks, CLOs, private credits, Ares, Apollo, Blackstone, yada, yada, yada. A lot of subprime non-bank lenders that no one's really ever heard of. Do you think that makes the banking system less risky? Has it been de-risked? It seems like if a lot of the credit risk is not in the banking system, it decreases the chances of a 2008 style banking panic that would just ruin the economy for a decade. What do you think?
Yeah, there's really not much of a chance of replaying 2008. That the banking system has, for better or for worse, in some ways it's better, in some ways it's worse. As we talk about the intermediation, the banking system has taken a step back. It is not, especially the larger banks. Let's differentiate there. The larger banks are not really at risk. Credit Suisse in 2023 was sort of an outlier for a whole lot of obvious reasons. I mean, nobody would be surprised if maybe Deutsche Bank runs into some problems down the road. But even that, I mean, Deutsche has been able to survive for how many years? And everybody said this is the final nail for Deutsche Bank, and it continues. So the big banks are largely fine. We're not going to have a whole wave of failures like we had in 2008. And that's normal after a crisis anyway. And even some of the smaller banks, the medium-sized banks, most of them are perfectly fine as well. What's really the issue here is that we don't have a perfect understanding of how the non-bank and traditional intermediation and the offshore liquidity to those non-banks really works under really stressful environments, because you're mixing a whole bunch of different things. For example, we saw a little bit of this just a couple months ago in early August. You talk about CLOs and who owns those? Well, Japanese financial own a whole crap ton of those. And they are funding them in different ways, like repo. And they did find out that when they tried to sell them, suddenly the liquidity they thought that they had in those CLOs just disappeared overnight. The repo collateral using those just wasn't dependable like they wanted it. So we did get a sense of, okay, there is potentially a structural liquidity mismatch between non-bank and foreign institutions and how the system has evolved really over the last couple years in more of a non-bank and more offshore environment, international mix, and they don't always align in the way that you think that it would. So it doesn't look like 2008 necessarily, but you still have the same general risks and risk types there. The repo market and collateral is still a big issue. We see that in the way the repo statistics have behaved since early August. We still have rising repo fails. Japanese 3-month treasury bill rate is continuing to be really low. That's another collateral signal. So there are some of the familiar things, but they've been adapted to different environments because of the way the system has changed, or at least the system has tried to change, because we keep coming back to the big problem in all of this, which is the banking system, which is a huge, huge part of intermediation, which is an underappreciated function of what banks and really the credit markets are supposed to be. That has never recovered from 2008, and it doesn't look like it's going to change in any way anytime soon. So the other side of that is banks are safer, but they no longer do what we need them to do. And so we have the challenge here is to find something in the middle, and that's where this private credit and non-bank sources have come from. They've tried to fill that vacuum, and it's been a trial and error type of thing. And I don't think they haven't really done the same type of job that the banking system would have.
Right. And if you were wanting to clock back 3 years, we're talking about fixed income investors, whether they're banks, non-banks, levered funds. If you had taken duration risk, owning a 10-year treasury note, 30-year treasury note, an agency mortgage-backed security, you would have gotten killed. You were down 20%. That's what Silicon Valley Bank did. All their losses were on duration, not on credit. Meanwhile, people taking credit risk, if you just owned floating rate bank loans, defaults have been very low, and you would be probably up to 20 to 30%. Based on your economic outlook, I would suspect that you think that's going to change sometime soon, that people taking interest rate risk will be rewarded and people taking credit risk will be punished.
That's what August was. August was the Japanese saying we bought CLOs based on not just CLOs, but we bought a whole bunch of US dollar and a lot of euro denominated assets based on soft landing. We had the idea that the US economy was exactly what you laid out. The credit risk was so low that we could trade from AAA rated to AA to single A to maybe even triple B and bless. We could do that with zero risk. And we had all these Wall Street types telling us that there's more extra risk premium and going down the risk curve because the economic climate was perfectly fine. And so once they got that taste of credit risk on that side of maybe there isn't a soft landing, suddenly everything shifted. And it shifted in such a way that it created a global liquidity air pocket, to the point that we had stock markets that are heretofore unbreakable. Suddenly they're being liquidated. Japanese market got liquidated in a way I haven't seen since 1987. So it was a window into the potential fragility of exactly what you're describing, and a whole bunch more beside it. Is that okay? If we've ignored credit risk for the last several years, believing a whole bunch of stuff. We don't need to get into what those assumptions are. I think people have a pretty good idea what they were. We've ignored credit risk, and now maybe we can't ignore it as much as we thought we could. It doesn't mean that everybody's jumping ship and saying, okay, we're into a recession and it's a nightmare scenario. It's just, do we want to be as out there on the risk curve as we thought we did? And so in just that small little shift, pulling back a little bit, it created a substantial global, you don't want to call it a systemic event, but it was certainly a wake-up call that there was more fragility in a lot of these places than people were realizing. And that's what's really driving certainly a lot of market changes, as well as, just general portfolio shifting that you see in any type of inflectionary period. People always overextend in risk, and then they start to pull back, and it leads to the back and forth fluctuation that we've been talking about in the markets as well as the economy. It's the same thing in portfolio shifts. You take a ton of risk, you realize that maybe you got overextended, you take a little bit back, and that causes self-reinforcing processes where other people do the same thing. And then everybody relaxes and think, okay, it was just a one-time thing. And then something else comes along. You're already overextended still. You thought, I only took a little bit off the table. I need to take more off the table. And so we went way overextended in the credit direction through the last several years. And there's going to be a process of pulling that back. It doesn't necessarily mean it leads to some kind of crash or nightmare scenario, but it will have consequences. There will be consequences in the marketplace that we saw in August, and there will be consequences across the real economy. And I think you're already seeing that outside of US dollar credit in a whole lot of different other places where people are starting to take some risk off the table just a little bit at a time. And I think that's what this cyclical inflection is about in terms of the credit markets.
Right. So in early August, we had the Japanese stock market collapse, the yen rallied tremendously, and the U.S. stock market, we had a flash crash there. So, and as you say, high yield credit spreads blew out. So in late July, high yield option adjusted spread 3.2%. A week later in August, 3.93%. So, over 50 basis points, over 60 basis points of credit spread widening
Yeah,
in a
which
week.
wasn't, I
That's
mean, that
significant.
was
But Jeff, now high yield spread is 2.89. So we're lower than we were in late July.
right. So what's happened is that people got to, they ran for the exits in early August and found out that the exits were really narrow. That's why credit spreads were out as much as they did. And then, okay, we can't do that again. We can't all sell at the same time. So they're just taking it very slowly and slowly and slowly, where the Japanese carry trade is still unwinding. It's just unwinding in more orderly fashion. So you still have this cyclical process going on. At the same time, the rest of the market has come back in, because everybody needs yield. Everybody's searching for yield. And there isn't a widespread systemic shift in risk taking that we saw in this narrow pathway, this narrow corridor. Japanese primarily, it wasn't just Japanese, but primarily Japanese were saying we need to take some risk off the table. That was just the first step. And so they're still taking risk off the table. And if there's another type of, the next payroll report comes in weak and everybody starts to run for the exits again, you'll see another spike in credit spreads. And maybe that one is that leads to the finally the systemic increase in credit spreads, because there is this institutional inertia where it takes several cracks at something for it to finally change to finally experience an inflection and change its trend. And we experience this all the time in everything we do. It's not, there's no one single thing where everybody at the same time says, we were absolutely certain everything is great and we can take as much risk as we possibly want because the soft landing is here. No, it's not like everybody changes their mind all at once. You have a little group of people change their mind. It creates a noticeable impact on the markets. The rest of the marketplace notes that, but they think, that's no big deal. I'm going to go back to the way I was before. Then you get another one and more people start paying attention. Then you get another one and more people start paying attention. And suddenly the trend changes. It's the same thing in the inversion of the yield curve, by the way. When the yield curve first inverts, it inverts in a little tiny bit way down the curve, and then it disappears. It just goes away. The yield curve doesn't just invert and stick. It usually goes back and forth, back and forth, back and forth. And then finally, usually several months later, that's where the trend actually shows up in widespread fashion. So if you look at credit spreads in the context of what happened in August, that was sort of the first one. That was like the yield curve inverting for the first time. And so it wasn't going to stick. It was just the sort of, maybe I should pay attention to something happening over here. But no, I'm okay. I'm going to continue doing everything I did before, because look at the latest payroll report that reinforces my biases about where the economy is. So I'm going to continue to take risks. But if there's another one, then I might be a little bit more inclined to take that one more seriously. And other people are more inclined to take that seriously too. And if it happens in widespread, and if it happens repeatedly in a way that it gets enough people's attention, that's where it leads to the inflection.
So earlier you said, so credit in the U.S. for the high yield market is very easy, but you said there were pockets outside of the U.S. in the offshore dollar system, the Eurodollar system, that were showing pockets of stress. What were you referring to?
Well, you look at swaps, for example, look at currency swaps, as well as some of the more derivatives, you see, especially related to Asia. You look at the way the currencies behaved. When the US dollar is an intermediary between other systems, what you're really seeing is that the yen carry trade reverse wasn't exclusively tied to, say, CLOs and US dollar assets. So the Japanese are taking less risk. They're not just selling out of US dollar assets. They're selling out of US dollars because they use the US dollars to go into other types of credit and other denominations of credit. So as the yen continued to rise, what that was saying is not necessarily that they're selling CLOs and US dollar assets, that major Japanese players were unwinding positions beyond US dollar assets and re-intermediating or repatriating back through the US dollar system. So the yen continued to rise all the way into the middle of September, even though US dollar credit spreads were going back to where they had before. So a lot of the yen carry trading was let's get out of other riskier assets that maybe not specifically US dollar, because that makes perfect sense. Even if you think the US economy is heading toward a recession, the rest of the world is much riskier than the US heading toward a recession. You probably want to still stick to US dollar assets in a global economy where the US is heading toward a recession. So it makes sense that, I'm going to lighten up as a Japanese carry trader. I'm going to lighten up on my CLOs and risky assets in the US dollar, but I'm also going to take more off the table outside of that. And because the Japanese intermediate through US dollars as the first step, that's why you saw the yen continue to rise, even though you didn't see the same thing happen in, say, for example, CLO spreads or other risky credit spreads.
Thanks. And Jeff, so when do you think high yield spreads are going to blow out to, 6%, 7%, recessionary? When is the unemployment rate going to go to 5, 6, 7, 8%? When is the stock market going to materially decline? I mean, based on your pessimistic economic outlook, these must be things that are, in your view, likely over the next 12 to 24 months, right?
Yeah, if I could tell you when, that would be great. But that's, who knows? I mean, that's again, we get back to, what are the yield curves telling us? What are these various market signals telling us? They don't tell us when, they don't tell us what, they just tell us that the probability spectrum is building in that direction. And so if I sat here last fall and you asked me that same question, say in October, as the bond rally is getting going, I probably would have said, yes, it would have been sometime in 2024. It's likely to happen because that's usually what happens in these types of situations. But that's not what the markets are saying. And that's, even though that's what I expect to happen at some point, I could not possibly tell you exactly when. And that's, of course, a major problem for people who are trying to transact and trade in the marketplace, because that's what it really is all about. If you're really risk averse and you think the economy is turning, you can't really say when. You're giving up a whole bunch of returns waiting for this stuff to happen. And the more that you wait for the stuff to happen, the more returns you give up, the more likely you are to say it's not going to happen and start taking risks that you don't want to take. So it's this is the most challenging aspect to everything. If there was a critical timing signal that said, okay, everything that we said that was a high probability is going to happen, this is when it's going to happen, then everybody would do it. You wouldn't need to be talking about it. So I'm still in the same position I was before. Those things that you just said, Jack, I still think they're going to happen, but I have no idea when. To me, they're still more likely than not. And I think more when they do happen, they will still be a complete surprise to most people because they'll have ignored all of these warnings along the way. And it's understandable why they do ignore them, because you've been talking about this for several years. It hasn't happened. So it's easy to fall into the trap and think, well, if it hasn't happened, this recency bias, it can't happen. And that's really when you see these things happen. Recessions tend to become the recessions that we associate with, the layoffs and everything else, at the moment that everybody's convinced that they're not going to happen. Think about 2008. 2001 is another good example. Everybody thought the first 50 basis point rate cuts from the Fed had done enough. And then all of a sudden in March and April of 2001, they got a whole bunch of layoffs, and everybody was pretty, even the bond market was pretty confident about how things happened, about how things were developing. So it's when nobody can answer that question.
So do you think there's going to be a financial blow up outside of the banking system in the private credit or private equity world?
Depends on what you mean by blow up. I think it's a loaded term, and I don't think I would use the term blow up. I don't think we're going to have a systemic crisis where everything just, a 2024 version of 2008 where non-banks become completely illiquid and have to fire sale assets. I don't necessarily think that's a high probability. I think there will be some problems when some of these non-bank and investment funds realize that they took way too much risk and they aren't, because they're over levered, that will create some sale pressures and liquidation pressures, but making that into some kind of monster systemic event, I don't think that's necessarily the case, because I don't think that's the way investment funds and liquidity streams are really, they don't have the same self-reinforcing dynamic that the banking system did in leading up to 2008. But that doesn't mean it won't necessarily create massive problems in financial markets as well as the real economy. That's really where the negative potential lies, is what happens when all of these sources of private credit, even if it isn't perfectly efficient, what happens when they start to turn off? I mean, we got a little bit of it earlier in August, but I don't think it's necessarily this monster nightmare scenario. I think it's just another negative pressure that could be potentially really negative, but another negative pressure on the real economy in the financial markets as a whole.
And you don't think that interest rate cuts and lower interest rates will stimulate the economy or even forestall a recession by increasing mortgage volumes or increasing capital markets activity, encouraging credit creation? You don't think that will be effective?
Never do. Why would this happen? Why would this be the first time? I really wish people would go back and look at the history, because you look at every recession and there's tons of rate cuts. I mean, the Fed started targeting interest rates in 1988, 89. really when Greenspan more formally adopted the interest rate targeting. Every single time, recession.
So Jeff, that is a point you made earlier. You said that rising rates are a good thing and that falling interest rates are a bad thing. And I see what you mean. You've called it, I think, the interest rate paradox, the interest rate fallacy. I would phrase it this way, that rising interest rates are a result of a good economy. They cause a bad economy. Falling interest rates are a result of a bad economy. They cause a good economy. So yes, in a recession, interest rates go to zero. In a depression, interest rates go to zero because there's a liquidity preference and because the Federal Reserve cut interest rates to zero because it's a depression. But low interest rates stimulate growth. In the same way, a high, hot nominal economy, they will cause interest rates to go to 8%, but they themselves slow down the economy. So that is why you have an equilibrium, because the thing that a good economy causes a creations that slows it down. A bad economy causes things that causes to heat back up. Do you agree or no?
No.
Oh, okay.
Interest rates are information. I think that there's this tendency to believe that interest rates are a control mechanism and therefore, or even that it's even like you're describing a self-regulating feedback loop. It's something like a Fugate cycle. If that was the case, then we would live in a perfect system where, just historically speaking, that low interest rates associate with bad economic periods because they don't fix the bad economic periods. That's why you have a depression, rates go low, liquidity preferences, everything else. If interest rates were effective at getting around the reasons why you had a depression, then zero interest rates would have worked in Japan. They would have worked everywhere else. So yeah, very Fisherian view of interest rates as information on both sides, and they're more information than they are control mechanisms.
So you have a Fisherian view. I think, do you mean that, if I get you correctly, that basically where interest rates are is where they are, and interest rates are always neutral. They are neither stimulative or cause a contraction. They're just where they are.
If the problem with that is that thinking that you can assign a single neutral rate. First of all, we would never be able to know what it is anyway. And I think it's a fallacy to believe that there's one neutral rate. If there is a neutral rate, there wouldn't be one, there'd be several. Not only would there be several, it would be moving all the time based on conditions that change. So if they're under that type of worldview, even if there was a neutral rate, I don't think we could ever figure out what it is. And so it might be that interest rates do move above the neutral rate at some points in time and then below it in other points in time, but I don't think we could figure out exactly what those are. Interest rates are, to me, a reflection of economic conditions and financial conditions and a whole bunch of other conditions, but they're not perfect signals. So it's not like we can just depend upon signal. And it's not, remember, it's a combination of signals about where things are today, as well as perceptions of where things are tomorrow, but not as a single, it's a massive probability spectrum. So we're talking about a probability spectrum that's narrower today and much wider down the road. And we're also talking about different interest rates at different times. That's why we focus on curves, because if the 10-year is doing one thing and the 2-year is doing something else, if the 2-year goes above the so-called neutral rate and 10 years below it, does that mean the market's tighter or looser? I think we look at different things at different times because there's different pieces of information at various parts and curves and various pieces at various moments in time. That's why it's to me, it's more informational than it is sort of have a direct impact on the economy or the financial markets.
Just to clarify, so Jeff, two scenarios. One, the Federal Reserve cuts interest rates tomorrow to zero. And two, the Federal Reserve keeps interest rates where they are at 5% forever. Are you telling me that you think that scenario one, where interest rates are at zero, will not be a slightly better, more stimulative economy than scenario two?
So the Fed is arbitrarily just choosing to lower interest rates to zero versus holding them at 5%?
Yes, all things being equal, because they want to fulfill my wish that I said on this podcast, as an example. Yes.
So in an arbitrary situation where the Fed just drops rates to zero versus leaving it 5% with no other, we're talking about this ceteris paribus, there's no other changes.
Mm-hmm.
Yeah, I think that in the long run, the market, the economy and the markets would end up in the same place either way. The short run would be different, but the long run would be the same.
Okay. The long run will be the same. So
yeah, because what you're saying is, I'm going to have the central bank arbitrarily distort some part of the financial mechanism and expecting that arbitrary distortion to lead to a predictable set of outcomes, right? That's what you're basically saying. What I'm saying is that the marketplace is saying if market interest rates are somewhere, it doesn't even matter in your scenario. Market interest rates are saying that the overall macroeconomic and monetary climate is such that we believe interest rates should be here over the long run. Then the short run distortion by the Federal Reserve will just eventually be short run distortions, in the long run ends up being what it would have been anyway.
Got it. Well, it's good to get your views on this. Jeff, people can find you on Eurodollar University on Twitter and on YouTube. Tell us about your research service and what people can find on YouTube and Twitter, as well as your website.
Well, as we've been just talking about for the last, over an hour here, it's all about, trying to read the financial signals that we get from the Eurodollar system, which is the real monetary system, the global reserve currency system, and what it actually does, because there really is no real insight and information beside what we get from the marketplace, which is why I use our logo and our analogy is the black hole, because we can't really see inside the event horizon to what's happening. So we're trying to, as best as we possibly can, interpret all of these imperfect signals in a way that leads to what we hope is a coherent picture of what might be happening in the Eurodollar system, as well as what impacts that will have across the economy and the marketplace. And it's not an easy task by any means, which is why we have our subscription services available, background, history, all of that stuff, the basics about curves and everything else.
People can find you on Twitter, Jeff, at JeffSnider_EDU. I, of course, am on Twitter at JackFarley96. And I'd like to remind our viewers that people can find Monetary Matters not just on YouTube, but on Apple Podcasts, Spotify, and everywhere else where you get your podcast. It really helps if you can rate it on Apple Podcasts or your podcast app and leave a review. Thank you, everyone, for watching. And Jeff, thanks again for coming on.
Thanks, Jack.
Thank you. Just close the door.